Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic is funds flow statement. So in previous sessions, we have discussed about the financial statements analysis like balance sheet analysis, profit and loss account, and income statement, trading account, etc. So after going through this topic, the learner will be able to understand the concept of fund, calculation of fund from operation, calculation of changes in working capital, and preparation of statement of sources and applications of funds. So let us start with funds flow statement. So funds flow statement is one of the financial statement which shows as to how a business entity has obtained its funds and how it has applied or employed its funds between the opening and closing balance sheets date during the particular year or particular accounting period. So it can be described as where got, where gone statement. So funds usually refers to cash resources and fund statement is prepared to show the net effect of various business events on the current resources of the organization. So in simple term, funds flow statement, it tells us about the sources of funds and how you are going to employ the same funds in different for different purposes or applications. So funds flow statement is a statement prepared to analyze the reasons for changes in the financial position of a company between two balance sheets. It shows the inflow and outflow of funds. Inflow is known as sources, whereas outflow means applications of funds for a particular period. In other words, funds flow statement is prepared to explain the changes in the working capital position of a company. There are two types of inflows of funds. First one, long-term funds that are raised by issue of shares, debentures, or sale of fixed assets. And second, funds generated from operations. Coming to the benefits of funds flow statement. Funds flow statement is useful for long-term analysis. It is very useful tool in the hands of management for judging financial and operating performance of the company. The balance sheet and the profit and loss account, which is also known as income statement, fails to provide the information which is provided by the funds flow statement. The changes in financial position of an enterprise that can be projected with the help of funds flow statement. Such an analysis is of great help to the management, shareholders, creditors, etc. Funds flow statement analysis helps the management to test whether the working capital has been effectively used or not, and the working capital level is adequate or inadequate for the requirement of the business. The working capital position helps the management in taking policy decisions regarding payment of dividend, etc. So, fund flow statement analysis helps the investors to decide whether the company has managed the funds properly or not. It also indicates the credit worthiness of a company, which helps the lenders to decide whether to lend money to the company or not. It helps the management to take policy decisions and to decide about the financing policies and capital expenditure for the future. And coming to the procedure of preparation of funds flow statement, it involves four steps. The first one is prepare the statement of changes in working capital. Second step, analyze the changes in non-current asset and non-current liabilities to find out inflow or outflow of funds. Third step, find out funds from operations. And fourth one, prepare statement of sources and applications of fund, which is also known as funds flow statement. So let us take statement of changes in working capital. So this is the first step in funds flow statement. So the pro forma of the statement of changes in working capital is like this. So which includes current assets, current liabilities, then we are going to find out the changes in working capital. So what comes under current assets? Stock, debtors, cash in hand or cash at bank, bills receivables, prepaid expenses, accrued income, short-term loans and advances, marketable investment. So here we are going to compare 2 years data. So based on that we can make out what kind of changes in working capital. When you are going to compare current 2 years of data, so we can able to make out whether there is an increase in working capital or decrease in working capital. So after that we should get total. The next, second, current liabilities. So what comes under current liabilities like creditors for goods, bills payable, outstanding expenses, bank overdraft, unclaimed or unpaid dividend, short-term loans and advances, provision for doubtful debts, provision for discount on debtors. So all those things comes under current liabilities. Again, find out the change in working capital. Then the difference between current assets minus current liabilities is nothing but working capital. So we can see that either there is an increase or decrease in working capital by taking the total of this. So this is about the statement of changes in working capital. Then second step, working capital changes. How can we find out? Means increase in current assets minus increase in, if increase in current assets, it means that there is an increase in working capital outflow. In case if you have increase in current liabilities, that leads to decrease in working capital. This is inflow. And third one is like decrease in current assets, then decrease in working capital, that is inflow. And decrease in current liabilities, that leads to increase in working capital. Again, it is outflow. Coming to the third step, finding funds from operations. So, in this step, we need to calculate the funds generated only from the operating activities of the business and not from the investing or financing activities of the business. So, the funds from operation shall be prepared as follows with the help of adjusted profit and loss account. So, first column is particulars column, next column amount. So we have two sides, debit and credit. So particulars, again amount. So on the left hand side of adjusted profit and loss account, these are the items that are going to furnish under adjusted profit and loss account. Two depreciation, two preliminary expenses withdrawn or off, two goodwill withdrawn or off, to discount on, to loss on sale of non-current assets, to provision for a tax, to proposed dividend, to transfer, to reserves, to interim dividend, to balance carried down. Whereas on the other hand, by balance brought down, by profit on sale of non-current assets, by transfer from reserves, by income from investments. So by funds from operations, the balance figure between these two is nothing but the funds from operations. Then next for that we have to add net income, depreciation on fixed asset, amortization of intangible assets, amortization of loss on sale of investments, amortization of loss on sale of fixed assets, in any kind of losses from other non-operating incomes, tax provision, proposed dividend, transfer to reserves. From that we have to subtract deferred credits, profit on sale of investments, profit on sale of fixed assets, any written back reserves or provisions. Then coming to the fourth step, statement of sources and applications of fund. So while preparing the funds flow statement, the sources and uses of fund are to be disclosed clearly so as to highlight the sources from where the funds have been generated and uses to which these funds have been applied. So this statement is also sometimes referred to as sources and applications of fund statement or statement of changes in financial position. So the funds flow statement as on so and so date. So here two things we are going to incorporate here. One is sources of funds, other one is application of funds. So under sources of funds, which tells us from where we used to acquire the funds. What are the different sources like funds from operations, sale of fixed assets, issue of shares, issue of debentures, loans taken, sale of long-term investment, receipts of dividends, legal claims, refund of tax, etc. Then decrease in working capital. Whereas coming to application of funds, how we are going to use the funds that are available with the organization. What are their applications? So it includes drawings, purchase of fixed assets, redemption of preference shares, redemption of debentures, payment of taxes, payment of dividend, repay of loans, increase in working capital. So that's how we used to prepare funds flow statements, which is also known as statement of sources and application of funds. So sources of funds means issue of equity, issue of preference shares, receipt of securities premium, issue of debentures, receipt of long-term loans from banks and other financial institutions, receipt of public deposits and other unsecured loans, sale of fixed assets, sale of investments, extraordinary receipt awarded in legal suit, income from long-term investments, funds from operations, decrease in working capital. Then application, already we have gone through redemption of preference share, redemption of debentures, premium paid on redemption of debentures and preference shares, repayment of temporary loans, secured on unsecured. So whatever may be the type of loan that is also included here. Purchase of fixed assets, purchase of investment, extraordinary payments, and non-recurring losses like loss by fire, damages, paid, etc. Payment of dividend and interim dividend, payment of tax, then comes increase in working capital. So coming to the formats of funds flow statement, there is no prescribed format as such for the preparation of funds flow statement. The only point to be remembered is that it should be presented in a clear and systematic manner. So, however, funds flow statements may be prepared in any of the following formats: report form, reminder type, report form, self balancing type, and report form reconciling type. So, all the three shown here, reminder type. Initially, we used to specify sources of funds, then we'll keep applications of fund. The difference between these two is nothing but the change in working capital. Whereas coming to second type, self-balancing type, sources of funds, on the other side, applications of funds. So based on the changes in terms of the difference, that should be considered either decrease in working capital or increase in working capital. Then third one is reconciling type, where we used to talk about working capital at the beginning of the year. We'll consider for that we have to add sources of funds. From that we have to subtract application of funds. Then we'll get working capital at the end of the year. So funds flow analysis consists of two different analyses. One is working capital analysis, another one is cash flow analysis. Coming to working capital analysis, it is the analysis and reporting of working capital. So working capital is excess of current assets over current liabilities. And this analysis consists of two statements. One is statement of changes in working capital and another statement is statement of sources and application of funds. Whereas second one, cash flow analysis, and is the analysis of inflows and outflows of cash. Cash flow analysis result in separate reports. One is sources and application of cash. So funds flow statement explains as to what caused the changes in the balance sheet items between two balance sheet dates. Coming to the importance of funds flow analysis. Funds flow statement is an important financial tool which analyzes the changes in financial position of a firm, showing the sources and application of its funds. It provides useful information about the firm's operating, financing, and investing activities during a particular period. The following points highlight the importance of funds flow statement. It helps in identifying the change in level of current assets, investment, and current liabilities financing. And second, it helps in analyzing the changes in working capital level of a firm. Third, it shows the relationship of new net income to the changes in funds from business operations. Whereas fourth one reports about past funds flow as an aid to predict future funds flow. So based on the past or historical funds flow statement, we can predict the future of funds flow. And next, helps in determining the firm's ability to pay interest and dividend and pay debt when they become due. It shows the firm's ability to generate long term financing to satisfy the investment in long term assets. It also helps in identifying the factor for responsible for changes in assets, liabilities, and owner's equity at two balance sheet date. So let us see the comparative analysis between income statement, balance sheet, and funds flow statement. So let us start with meaning. So if you take the meaning, income statement meaning is the statement showing result of activities conducted during the year, whereas balance sheet it is the statement of assets and liabilities of an organization, whereas funds flow statement of changes in assets and liabilities of an organization. Then second basis is objective. So income statement's objective is to ascertain profit or loss, whereas balance sheet ascertain financial position and funds flow statement to know the change in financial position over the year and how the profit has been utilized. Then third basis is legality. So in case of income statement, obligatory to prepare as per schedule 6th of the Indian Companies Act 1956, whereas balance sheet it is obligatory. Even funds flow statement is non-obligatory in nature. Coming to the format, no format in case of income statement, but should be subject to certain requirements. Whereas balance sheet, we should prepare in a prescribed format, and even for funds flow statement, there is no prescribed format. Then next, coming to the sections, income statement will have only two things, two sections. One is income, another one is expense. Whereas in case of balance sheet, again, assets and liabilities, the same when you are coming to funds flow statement, which becomes sources and applications. Then coming to the basis, income statement prepared on the basis of nominal accounts and other information. Balance sheet prepared on the basis of ledger balances and additional information. Coming to the funds flow statement, which is prepared on the basis of two consecutive balance sheets. Let us take one example. From the records of a company, the following information has been extracted. Net profit after providing the following items: 80,000, loss on sale of equipment 50,000, Premium on redemption of debentures 1000, discount on issue of debentures 2000, depreciation on buildings 15,000, depletion of wasting assets 5,000, goodwill written off 20,000, interim dividend 20,000, profit on sale of fixed assets 35,000, excess taxation provided given 20,000, income from investments 5,000, transfer to general reserve 6,000, preliminary expenses written off 1,500, profit on revaluation of investments, that is 2,000. So using that data, so I have prepared the funds flow statement. So first start with the net profit, which is given 80,000. Then for that we have to add non-cash and non-operating expenses, where it includes loss on sale of equipment, discount on issue of debentures, depreciation on buildings, depletion of wasting assets, goodwill written off, excess taxation provided, transfer to general reserve, preliminary expenses written off, premium on redemption of debentures, interim dividend. Then we have 1,85,500. From that we have to subtract non-cash and non-operating incomes. So that is profit on revaluation of investments, profit on sale of non-current assets. It means that fixed assets. Next, income from investments that we should specify, and funds from operations. Now let us take another example. From the following data, calculate funds from operations. So we have given sales, cost of goods sold, salaries, rent, selling expenses, office expenses, preliminary expenses written off, tariff to general reserve, postage and telegram, excess provision for tax return back, loss on sale of fixed assets, interest received on investments, profit on sale of investments, and from the profit and loss account, we should take opening balance and closing balances. So let us prepare operating incomes. So sales minus operating expenses, then we'll get funds from operations. So operating expenses include cost of goods sold, salaries, rent, selling expenses, office expenses, postage and telegram, etc. So from the following data, prepare funds flow statement. So we have given balance sheet, liabilities and assets. Then using that, prepare the statement of changes in working capital. So first write down the current assets for the 2 years. Stock, if you observe 2015 and 16, there is an increase. So I wrote increase how much? 10,000. And even debtors, if you take, increased, bank increased, cash reduced, then find out the total. In the same way, current liabilities. So we have given sundry creditors, bills payable, outstanding expenses. Then find out the working capital A minus B. So net increase in working capital, that is 82,800 to 2,800. So there is an increase in working capital. The next we have to prepare funds flow statement, which consists of two things: sources of funds and application of funds. Under sources of funds, specify increase in share capital, issue of debentures, secured loans received, sale of plant and machinery, funds from operations. Other side, applications. Then find out whether there is an increase or decrease in working capital. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.